Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, May 29th, 2018. I hope everybody had a good, or at least those in the U.S., a good long weekend. Good weekend, everybody else. We had, obviously, the markets in the U.S. were closed yesterday for the Memorial Day holiday, so we're starting out an abbreviated trading week. And what I wanted to start out with is a follow-up somewhat to a post I made a couple weeks ago. I highlighted Greek. This is the Greece ETF. GREK is the symbol. And at the time, I pointed out that it was testing a key uptrend line support. And I also like to watch Greece bond yields. So this is the Greek 10-year government bond here, and I mentioned here on this chart that I overlaid with the chart of the ETF, their market, stock market, that at 4.5% seemed to be a pretty significant technical level. You remember a few years back when there was all worries about Brexit and all that good stuff, Greek leaving the European Union. There was, spike in Greek bond yields and, risk of default and all that good stuff, yada, yada, yada. Well, bonds will tell a lot. A lot of seasoned investors, a lot of pros watch, whether it's in the U.S. or watch Treasury bonds or any particular country, watch that country's the government bond yields, and it can give you a little insight to what might be going on with the market. So either way, technically I could see that 4.5% was a significant level back then. So I said, let's watch that, see what happens to that level. In other words, if yields go up, then that means all other things being equal, the market's pricing in additional risk to the country. If the bonds are now yielding more, that's what the market's demanding, a higher yield to buy those bonds, pricing in whether it's inflation or in many cases an increased risk of default. So either way, we have both the equity markets, the Greek equity markets at support, and bonds back then a couple weeks ago at resistance. Let's take a look and see what's happened from there. Let's start out with the bonds. This is a live chart here. I don't have that same level drawn, but you can see it right there. There's a line. Actually, they had it already right at 4.5%. I guess since then, you can see that we took that level out, and Greek bond yields have been moving up pretty sharply. That's a significant rally so far, almost up to the 5% mark in short order once that level is taken out. So that's a red flag for the Greek stock market as well. More importantly, is the fact that the stock market's broken down as well. Let me find that chart. There we go. Uh, so shortly after that post, we did go on to breakdown. We had a little kickback rally. Remember, this is an ETF. This is also denominated in U.S. dollars, as most of these ETFs are that I'm going over. So they might mirror or not exactly mirror the markets that we're looking at here. But the point of this video is twofold: to kind of give everyone a big picture of what's going on with the global equity markets, not just the U.S. markets that I focus on so often, but also these are trading opportunities as well. Way to diversify your portfolio, whether you want to go long or short. I'm going to give you my opinion on these, let you make up your own mind, but I will point out some key levels. I think this was an important trend line. You can see the impulsive selling. That's the nature. It helps to confirm the validity or importance, if you will, of a trend line when you see a breakdown and you see important selling. Now you see a bunch of big gaps. You don't see big long red candles. That's because this is they're trading halfway around the world. This ETF is trading on the U.S. market, so therefore you're going to see a lot of gaps. So what this would look like over there are big red candles, but of course when we open here in the U.S. markets at 9:30 Eastern time, their markets, whether they're closed or are closing soon, you're going to get these gaps there. So there it is. Also, I added to this chart. We did that this correction here, just like this one, they follow divergent highs. So, that's a big part of my trading style. Look for these divergent highs. They mark significant tops and bottoms on divergent lows. Sometimes we have, like we did here, we had a divergent low. I'd be remiss not to point that out. That told you at this point, time to go long, trend reversal. Simple watch, rinse, repeat stuff. Doesn't work 100% of the time, but more often than not, that can help you sniff out the tradable trend. So what happened here after this divergent top and correction, we pushed up, made another high, and an even larger divergence. It was really just an extension of that previous negative divergence that we had off these highs back here in early to mid 2017. Another correction, and now we've broken down below trendline support. We are oversold, but again, we just broke down, and as I mentioned, Greek bond yields have now popped above that pretty significant 4.5% level and are running up towards that 5% mark. There is a previous reaction low right here. That's a natural support level. So, not the most objective time to short right now. The objective time was on a breakdown there, and we've already dropped about 7.5% from that breakdown, about actually closer to 8%. So we are coming up on support. Probably time for an oversold bounce soon, but longer term picture doesn't look so hot. And I want to go over again some of the other markets here. And before I move away from Greek, this is the bigger picture, and we're going to do this. I'm going to spend probably more time on the bigger picture on these charts. And again, I'm going to go through a handful of the top, global equity markets. This is not one of them, but it is, if there's blow up in any particular country. It could be small. Obviously this affects the EU. So, problems in Greece, as small as that market is, could have repercussions throughout the global financial system. This is a 10-year weekly chart. Very clean, this chart speaks volumes to me. We had a divergent high back here. It was very clear divergence. You can see the negative divergence on the PPO, on the RSI. You can see a trend line sort of terminated in a wedge type pattern. It broke down, and that ETF fell from highs to lows. I have it marked here anyways, 76, about 77%. There it is, 78% plunge following the weekly divergent high. So you can see that, you need to take heed and be aware that this can play out for a lot more than what I just showed you. I showed you we're coming up on support, but this is the first divergent high that we've had on the weekly time frame since going back to 2014 when this ETF fell by almost 80%. And so we had a divergent high so far. Off that high, we're only down, relatively speaking, 25 or so percent. Will that be it? That's possible. You don't always get such a big move off a divergent high. But again, to me, this trend line is even better defined, the trend line off the early 2016 lows, than was this trend line back here. So there it is. Divergent high, breakdown, weekly time frame. Enough spent on Greek, but it is, I think, headed lower. Any near-term oversold bounces aside, I think the longer-term outlook is bearish. All right, let's look at a few more. Okay, to kind of put things in perspective, this is a chart. I haven't verified this source. I just did a quick Google search. This website here shows distribution of countries with the largest stock markets worldwide in 2017. So it's showing the U.S. at about 51%, as I said earlier, I believe I said. So, that's where most of my focus is. Again, I live in the U.S., trade the U.S. markets, and they, for the most part, will lead the rest of the world. The rest of the world will follow because we are, the weighting's so heavy. However, it is, worth taking a look at some of these other markets. I'm trying to get the pop-up box to go away, but you can see the numbers there. Japan at about 8.6, UK 6% or so, and then most of the others, France, Germany, China, Canada, Switzerland, Australia, are all coming in around 3% or so. So we'll just look at those and maybe a couple others, if time permitting, that stand out. Like emerging markets. Maybe we'll look at Brazil and Mexico. But I wanted to cover these again for two reasons: to kind of get a bigger picture of what the world markets are looking like, and if you happen to trade any of these countries, or even if you're in the U.S., because I'm going over the ETFs here that trade on the U.S. exchanges. Very simple to trade these in a brokerage account here in the U.S. Or if you're in another country, I'm sure there's you have some type of proxy for going long or short any of the global financial stock exchanges. Okay, what I'll do is I'll go through those in order of their weighting that I just did. Actually, so therefore I need to start with SPY, the U.S. markets. S&P 500 is really the most representative of the U.S. stock markets, more so than the NASDAQ 100. And I've gone over this chart so much recently, and I have constant coverage on the U.S. markets. But there's the primary uptrend line. This white trend line comes off the 2009 lows. I'm just going to start here with the weekly charts. Time permitting, I'll drill down into the daily charts because that gives us a little more heads up on what's going to happen near term. This is painting the longer term, the bigger picture. So as I've covered in past videos, I have the primary uptrend line, which is so far this white uptrend line still holding support. We've had numerous tests. I haven't seen a trend line tested so many times, at least not in the broad markets, throughout this bull market. We've had, these are all weekly candlesticks. 1, 2, 3, 4. This one didn't test, was a little above, but then 5, 6. we've had a lot of tests here. So we've been skirting above this, testing this support with a lot of stick saves, as you can see. Intra-week, we've had a couple breaks, but we've managed to close back above it. Let's tighten that trend line up just a hair. There it goes. And you can see it's actually, we had another one back here when we had that big meltdown there. So a lot of tests. It's a beautiful trend line, in my opinion, one to watch. And when it goes, and I think it's, it's a matter of if not when, then we'll most likely, we'll have to confirm with some other things out there, but we'll most likely have broken, well, will have broken that primary uptrend line, but we most likely will be in the early stages of the next bear market, or at least a very significant correction within a larger bull. But again, I think that'll mark the beginning of the next bear market. And there's an alternative uptrend line as well that I have right there off the 2016 lows. A lot of stocks and sectors have this trend line as well, so I think it's important to put it up there. And again, I called it an alternative uptrend line, with this being the primary uptrend line, but one that I think is significant. And you can see we had that big red candle once we broke down below, and we've been trading under that trend line since. So there's the U.S. markets in a nutshell. Holding up for now. Let's just go through the rest of these. Let's start with Japan, as that's the second largest, and that was Japan is EWJ, I believe. Yes, and I'll start with the weekly charts here. Time permitting, I'll roll into the daily charts to give you a little more heads up on when, when we might have some sell signals. If we don't already, in some of these we may already have it. I could add a lot of other trend lines here, but what I wanted to point out here is the divergent highs. These weekly charts that I'm doing, and if I don't make mention on the time frame, it's right up here in the corner. You can see weekly EWJ, and they go back 10 years. So you can see we had a divergent high back here. You can see the negative divergence marked down below. We had a divergent high here, and this time we didn't have a divergent high, but what I did note is we had you can also look anytime the RSI is crossed above 70 level, or heck, for that matter, even hit the 70 level, we've had significant corrections. So there it is. So you have oversold in itself is usually a reason to either reel in your long exposure or go, short. You got to look for the sell signals. You can't just short overbought. I said oversold a minute ago. I meant to say overbought. You can't just short overbought, especially in a bull market, because overbought often does and can become more overbought or stay overbought for an extended period of time. However, that usually lasts for maybe a few months, and then you get these major trend changes. So there it is. So there's Japan. Sometimes those pullbacks come pretty quick, and you have this primary uptrend line to watch right. Pardon me, I had a brief interruption there. So this is what I'm watching right now. So we're coming off the second most extreme and probably the most persistent overbought reading since going back here to 2013. And at that point, we had a very sharp correction. Initially, big drop in EWJ, followed by we never even saw those highs again for it was almost 2 years later. So that was also followed by 2 years of sideways trading off that high right there, popped above it, fell back down. So really, if you look at it from here to here, you're talking two plus years, 2.5 years or so of about sideways trading, and then we started the next trend. So now we are again at coming off extreme overbought levels, and we're at this point in time, we have a very well-defined uptrend line, which is just starting to crack. I mean, we're precariously sitting on that trend line. Today's Monday, or I'm sorry, it's Tuesday, 4-day week, so we could close back above it. Again, all that matters is what happens at the end of the week. But Japan, in my opinion, is in a precarious position. We have to see that trend line go on a closing weekly basis. And again, take all of these markets in together. If just one market breaks down and the rest are holding support, I think you'd be jumping the gun to go all in heavy short on that one. You want to see the majority of these markets break down, especially the U.S. markets. And again, anything can happen here. If the bullish scenario would have this, I think one more thrust up, something along these lines, especially if we can get a divergent high, marginal new high, and then go on to breakdown. What that would do, if you look down here on the indicators, which are lagging, it would give us what I love to see. You don't have to have it. There's a lot of tops that come without it, but we'd have that divergent high, negative divergence on the weekly time frame. So there's a bullish scenario, and just to kind of estimate how much would we need to punch out to put a marginal new high? Well, about at least 7% or so, 6% minimum just after. Well, no, call it about 7 from. No, I take that back. That's not from where we're at. From where we're at, we'd need about 9% or so to put in a marginal new high. Regardless, I think you're picking up nickels in front of a steamroller being long a lot of these markets right now. That's my opinion. We'll see. I'll go through the rest of these real quick. Number 2, that's Japan. So then we have the UK, which is EWU. And this chart doesn't look good to me. You had a divergent high back here. You can see, these are significant corrections. This is, 28% drop back there. You had a divergent high right here, followed by a 37.5% drop. You have negative divergence right here. So this was also our most recent divergent high in the UK. There it is. Breakdown of a well-defined trend line, breakdown and a backtest. This is a bearish chart to me. We were also at the most overbought reading that we've been in possibly in history. I know on the S&P 500, this is a weekly chart again. We hit the most overbought reading that we've seen in the S&P 500 at least for 20 years, if not. That's as far back as I went. So this is a bearish chart, and I think the UK. Well, it's clear to say, top back here in 2014, this market's not even anywhere close to, at least this ETF, it's not anywhere close to its highs. So there's a bearish looking chart with more downside to come. Next up, we have France, and that is EWQ. There it is, same story, divergent high back here, big drop. You can see all the drops. This was a divergent high, not sure why I didn't mark it. And there's a lot of charts that I covered this weekend, guys, so forgive me, but just wanted to put this divergent high in and point out that this is not random stuff. You had a divergent high, a well-defined uptrend line, terminated a rising wedge, and you can see this is what I keep talking about. When these trend lines break, when they all start to go, especially the U.S. markets, we're starting to see these other markets break, and I think it's only a matter of time before the U.S. markets follow. But what we tend to see is stocks fall a lot faster than they rise. You can see that after EWQ broke, it was measure that out for you right there from the highs that's to the lows right there. That was a 31% drop, but that first part of it came in just a matter of 4 months, and we dropped 24, 25% in 4 months. And that's the thing, is stocks tend to fall a lot faster than they rise, and this is what I continue to the reasoning that I am 401k long-term money. I'm out of the market now. Equities, I have bonds, other things, commodities, gold, things like that. But I think that the risk reward on the equities is awful at this point. It may be 4, 5, 7, 8% upside if at best, but maybe not. Maybe we don't even get that. And talking 20+% downside. So there's EWQ. Not much else I can say. This is a beautiful chart. Divergent high, well-defined uptrend line. We've broken down. Again, it is a weekly chart, so let's see. Maybe we get a stick save here. But this stuff is priced in. These divergences say don't try to get cute and pick up, buy a breakdown thinking you're going to snap back up. If you do, yeah, great. Maybe we do, and then we go and make a marginal new high. So there's France. Trade it as you will. Let's see. Next up, Germany. Germany is EWG. Here's Germany, same story, divergent high, big drop, back then 40+%, divergent high. And these divergent lows work too. Here's the positive divergence at least on the RSI, close to it on the PPO, and that marks your bottoms. And so here I have two things. I have this uptrend line. If we zoom in, it's not super well defined, but I did put it there. It sort of culminates in this uh, rising wedge pattern, but you can see the negative divergence is clear. That stands out to me. We have equal or lower highs in the indicators, lower highs in PPO, roughly equal high in the RSI versus higher highs in price. An impulsive breakdown, again, this helps to validate that trend line that I have there. That's why I put it there. You have a big red impulsive candle. We've yet to take those highs out. We haven't come back above that breakdown. And now we have this yellow line here, which has a lot of reactions. You can see going back quite a few. And these two lines, I'll color this one yellow so you'll see what I'm talking about. forms what's called an ascending broadening wedge pattern, or at least has that shape. We only have two, well, we do have close to three reactions, really two on the top, but we have several on the bottom, and most importantly, it's a trend line there, and now we're starting to crack below that. So, uh, my opinion, again, this is just me. I can't tell you what to do. I think it's time to get out of Dodge as far as equities go. There's another trend line. So let's move on to the next one. Let's go to France, and that's EWQ. There it is. Divergent highs, divergent lows. Swing those. These are your big major trends. Well-defined trend line, divergent high, breakdown right there. So there it is. We're seeing global equity markets. Everybody so far but the U.S. And as I continue to say, the U.S. is only a bad day or two away, meaning doesn't mean it's going to happen in 1 or 2 days. I'm just saying if we have a couple of those 3 to 5% big red days, big red candles, it'll take us below those trend lines on the weekly or daily time frames. So China, there's a couple. We can look at FXI or as one of these. I've been using the iShares, so we can look at that. China's sitting right on trend. What stands out to me on this chart right here, if we look at these overbought readings right here, overbought right here, and we were overbought right here leading into this divergent high, you can see the drop, you can see the correction. Simple stuff here in my opinion. Overbought, we hit overbought right here. And that was followed. That was also with a divergent high. So that's what I really love to see is overbought with negative divergence for tops. Overbought right there. Sometimes you don't need the divergence. Simply an overbought reading, as you can see here. And if this doesn't look like much, I'll take the smallest correction we had following a minor, that was a slight overbought reading. That was still almost a 12% drop in FXI right there. Overbought again. That time we were good for a drop of 40, almost 47%. So you get the picture. Without fail, without any exceptions, every time FXI has been overbought in the past decade, it was followed by a drop of measured in double digits. No exceptions. This time around, this is what I call persistent overbought readings. Yeah, we did have a little bit of a hiccup there, but we pop right back up. And when I have overbought readings in close proximity, I call that a double tap reading. This is really one of the same. Even though we fell back below it, there was hardly any separation between overbought. This was near overbought. We still dropped. So there it is. So we're coming off one of the most overbought and certainly the most persistently overbought readings in a long time in FXI while we're at primary uptrend line support. And you can see that prices are just, here's that support level right here. We're holding that line right there. When we break below it, that's where all the trades have occurred for the last few months here. We break below it, we're also breaking below trendline resistance, and I think we'll see something like this. And this is why I do these videos, why I talk so much about it. When the markets drop, they tend to drop fast, and if you don't have a trading plan in place, by the time you realize what's going on, you're going to be underwater, or you'll have missed out on some lucrative shorting ups. And this is just another proxy for China, GXC. This is a Spiders S&P China ETF. Same thing. You can see all these overbought readings down, or yeah, overbought readings marked down below, and you can see what's happened in each of those instances down following those overbought readings. Pretty simple stuff. There's the smallest one right there. There's some pretty significant ones, but without fail. So this is just one persistent cluster of overbought readings. Here's a trend line right here, really a price channel. And again, so there's also some horizontal support that we're just clinging to in China right there. We need to take out that 105.70 to 103-ish level right there. Next up is Canada. Next up is Canada. EWC. I probably should have covered that earlier, but what I was doing is going in order again of the weightings here. So Canada, according to those statistics in 2017, about 2.9%. But I do have a lot of Canadians on the site, so let's spend a little time on this one. There it is. You can see divergent highs. What I've circled here, or boxed in, I should say, are not just the over. There's some overbought readings you can follow. You can do this on your own chart, but the ones that were very clearly overbought, well above that red line, the 70 level on the RSI. So we had a divergent high and overbought, and that was followed by a drop of 32%. in just short order. Again, we're talking 6 months, a drop of 32%. Another great example of how stocks tend to fall, faster than they rise. There it is again. We had a negative divergence. It wasn't very big, but there was divergence. You can see the divergence lines and the overbought conditions. And although it was a small divergent high, that was followed by a drop of 45% in the EWC. Here we are again, and you can also look at take something else. Look at this. This is the look at the spacing between these drops. It's several years, and it's been several years since the last bear market in Canada, and we're off the lows. This bull market since that last one ended, we jumped up almost 70%. So there it is. Wash, rinse, repeat. This is exactly what I saw back here. Back here, I saw extreme overbought with negative divergence. There's a divergence line on the RSI. There's your divergence line on the PPO. And we have this minor trend line. I'm not crazy about this trend line, but it's worth putting here because there's some reactions there. Looks like we're dancing above there. So the near-term outlook doesn't look great for Canada. If it does, if this ETF happens to punch up, wrong trend line there. I'm trying to put a trend line tool. There's a potential again. Maybe we get another divergent. I don't see it. And I want to say this, guys. I have to keep this video short. I want to wrap it up in just a minute here. But I also went through all the holdings of EWC, which are the largest Canadian companies. And all of those, just about all of them confirm. The majority of those confirm there's probably a top in the Canadian markets. But there it is. What I'm showing you here is again my most optimistic scenario. Maybe one more thrust up. Squeeze out any shorts that are in there, or just get some more long sucked in on especially on the retail side, retail investors, and then that would just be an extension of these existing divergences that are already in place. So that's Canada. Hit on a couple others real quickly. This is EEM, Emerging Markets Index. So this has a compilation of various emerging markets. There's a trend line, a potential trend line. We only have one, two. This would be the third reaction. We had this minor trend line that broke. Could put a horizontal support level there as well to watch. You can see a lot of reactions from above right here, reactions from below right here. So this is a level about 45. It's do or die time for EEM. Support, like I say, support is support until unless broken. So just watch that. If and when that level breaks, whether we get another thrust up in EEM in the coming days or weeks or not, this would be my target zone down here. Wrong line, there it is. So somewhere between these two levels, there would be just eyeballing that chart. Nice target zone. Looks like a nice inverse head and shoulders pattern down here too that played out on EEM. A couple others. We'll look at Italy, EWI. That's not looking so hot. Italy's in free fall. Look at this. There's a lot going on right now in Italy. There was support right there that's been taken out. We had this uptrend line, broke down, back tested. We had a divergent high too. You can see the negative divergence. I don't have it all drawn out here. Again, this is a weekly chart. I've just stuck with the weekly time frames. Italy is, the nature of this stock market is really these steep rips and dips, sharp uptrend lines, very steep uptrend lines and downtrend lines, as you can see. And when you get a breakout, those are your buy and sell signals. Sometimes you break down and you kick back and back test like you did right here, and then comes a correction. Another one, breakdown, back test, boom, there's a correction right here. Breakdown, back test, boom, so far. It's playing out a little slower than these past breakdowns, but I just wanted to mention that's the nature of this beast are these quick rips and dips. You don't see a lot of sideways consolidation in the Italian markets for whatever reason. That's just how they trade. A couple more. Yeah, let's look at Spain, EWP. Actually, I had a note to put it there, but I hadn't annotated the chart yet. I can just look at this and tell you we had a big old gap right there, and we've been trading above this level, and we've taken that out now. That doesn't look so hot. We also had, there it is. There's what stands out to me, negative divergence right here at the high. You can see the indicators lagging. So we're coming off a divergent high. The last time that I see we had a divergent high was back here, and you can obviously just go ahead and see what happened after that divergent high, which of course also was coincided with overbought readings. And then before that, we had a divergent high right here. So either the charts play out as they normally do or they don't. That's it. But the way I see it, I think there's more downside in the bigger picture too. You look at a lot of these charts, some of these um, overseas markets, just they've been in not so much bear markets, but sideways trading ranges for the last. This is still off its highs from 2009, well off its highs. So that's not looking good long term. There's got to be something to be said about a market that, with the U.S. markets way, way off their, above their 2009 highs. And you see a country like Spain, that's not good. EWW, last one, I think we'll wrap it up here. This is Mexico. Um, I thought I might have had that chart marked up on the weekly. I don't. I do have this on the daily. I see some positive divergence. Now, there's a lot to see here. You can see divergent highs and lows. And these are, again, swing trading by swing trade time frames. We had a divergent low right here. It was a good time to get long that. And then we had a divergent high right there. It was a good time to get short. Bigger picture we have only on the RSI, we have positive divergence right here at this low. We have the PPO starting to curl up. Uh, hard to say how much upside is would we'd have in Mexico if the rest of the markets melt down, especially those larger, developed countries. But wanted to point that out. So we'll say neutral to cautiously bullish on this one, but the majority of those other countries, some longer term bearish. And we'll wrap it up here. If there's any that stand out, particularly as actionable trade ideas, I'll post those on the site for members with a setup, looking at the daily charts, maybe even the 60-minute charts, along with some price targets. This has been Randy Finney with Right Side of the Chart.